Yeah. Yeah. Well, let's kind of get started with our first question because it kind of leads into that. So
Yeah.
I really believe that every buyer realizes that they're not locked into that rate forever, especially the first time home buyers that I'm kind of running into. And there's this thing called refinance. So let's kind of do a mortgage 101 with our first question. If a buyer has been listening to us and takes our advice and buys now at, let's just say 7.5%, and then refinances later when rates are down to, let's say, 5.5%, what does a refinance look like? And is there such thing as a free rate refinance, or what's a refinance going to cost a buyer? And you know what? Actually, let me take this.
Loaded question.
Yeah, it's a loaded
Okay.
question. Let me take it a step further. If is there a difference between a buyer that starts off a new loan with you and comes back to refinance versus a buyer that's got a loan from somebody else and then goes to you for refinance as well?
Good question. A lot of lenders out there right now. Let's first unpack what a refinance is, like you said, for first-time home buyers. So you're not locked into that loan for the entire time that you own the house. You do have the ability to take advantage of market improvements and lower interest rates, or maybe you start with a loan that has mortgage insurance, and now over time your house has gained equity and you don't need to have mortgage insurance. There's some steps we put you through versus just instantly saying, like, you got to refi to get rid of the mortgage insurance. Other options out there that we have you try first. Um, but that is something where you can pay off the current mortgage through the process of getting new mortgage at current terms, right? And we normally see that when rates drop. We want to take advantage of that. We saw that during COVID. People bought houses at 4.25% and then refinanced at 2.75. The reason why I say your question is loaded is because there's certain lenders out there right now that are marketing, hey, come buy with us now. You'll get a free refinance if you use us in the second time. A lot to unpack. How can they do that? How do they say that? So first, I'll explain our side of the equation. Being a mortgage broker, we don't have lender fees. We don't charge underwriting, processing. In Arizona, you're going to see those fees range from anywhere from $1,500 to I'm hearing as high as $2,000 now. Okay. As a broker, we don't have that. So when we say come back and refinance with no charge, it's no different than when you bought the house, that there's no lender fees. Now, you're always going to have third-party fees, title company fees, taxes and insurance. You're reestablishing escrow accounts that your taxes and insurance will be paid out of. Those are always going to be a cost. Now, there are lenders out there saying, oh, we'll pay those too. Guess how they do that? Through a higher interest rate that yields them a higher revenue on your loan so that they can then in turn give you a lender credit towards those third party fees.
Okay.
So free means different for different lenders. Free could be that they're removing their lender fees. Free could mean that they are paying all of the closing costs, which means to do so, right? I can't go pay $1,000 worth of title company fees that aren't even mine without generating extra revenue. And the only way I do that is by offering you a higher interest rate. And then that's going to come with more revenue than I can contractually make. And my only option then is to give that to the consumer as a lender credit, thus paying those third party fees. So be very aware of that. When somebody says we're going to do this for free, are they a broker where there was never going to be lender fees anyways? That's why you don't hear me say we do free refinances. We have no lender costs every time you do a loan with us. And then the second thing is, am I getting a higher than market interest rate to get those third party fees, right? Nobody out of the goodness of their heart is doing a loan for you and going and paying a couple $1,000s worth of fees that aren't even theirs without that revenue coming from somewhere. And it's always through the interest rate. So that's the first thing to understand on that. Now, average closing cost, depending on the level of your taxes and insurance, what time of the year, like how many months are you away from that insurance policy renewing? You're looking at, with a broker like me with no lender fees, about $3,000, give or take. Now, really, the net is the title fees, which are usually about $1,000 on a refinance, because anything I have to collect in terms of taxes and insurance to set up the new escrow account, you're going to get almost, it's not quite a wash, but you're going to get almost that back as in a form of a check from your current loan servicer 30 days after we close your refi. So if I have to collect $1,200 worth of taxes and insurance, you're probably getting about $1,000 back a month after we close, right? They got to close out that escrow account. All the money you've paid into it is still yours. They owe it back to you in Arizona by law. They have to cut that check within 30 days. So net is you're usually looking at somewhere between $1,000 to $1,500 in cost to refi. Now, it makes sense to roll those fees in. A lot of people say, Jeff, I'll come to the table with the $3,000. Roll it in. It's going to add at a 5 or 5.5% interest rate. It's going to add about $15 to your payment. So all we do is take the $3,000 you saved, divide it by the $15 extra you're going to pay a month. That end result of that calculation is 200. That's 200 months to break even, about 18 years before you break even. So it always does financially make sense to roll that into the refinance as long as you have the equity position to do so.
Okay. And you're talking
Does
about
that answer? I know that was like a three-part question.
yeah. No, that does. So that rolling over is basically just the buyer's impound, not the title fees, correct?
You would want to roll all cost into the new loan. Yeah. Always makes sense just because the cash that you're giving up out of your pocket is costing so little to finance that into the loan. But the chance that you're going to be in that loan for those 18 years and come out ahead by paying for it versus rolling it in, very minimal. So you end up losing money if you don't roll it in.
Okay. All right. That makes